Hello, and as a valued Empower Wealth client, I'm delighted to introduce you to episode 5 of Talking Property Tax with Julia Hartman. Now, if this is the first time you've been listening or watching this series, Talking Property Tax is our educational tax series led by Julia Hartman, who is one of Australia's leading tax experts when it comes to all things property investment and all things personal tax matters. Now, Julia is the founder of the Ban Tax Group, which is a tax cooperative group of which Empower Wealth is a member. Julia is also our Chief Technical Tax Advisor here at Empower Wealth. So welcome to the Talking Property Tax, Julia.
Thank you, Ben. Good to be here.
Now, in today's episode, we're really going to be 100% focused in on the 2024 tax season and planning, because we haven't got long to go, around 6 to 7 weeks before it's the end of the financial year. So that's really important. Now, before I get started, for those who are new to this show, there are 5 other shows or 5 other episodes that we've broken down, and you can learn all about them in the show notes below. So you can click on those episodes where we cover off on a lot of tax planning and also a lot of tax matters. Some of the most common questions we get around property tax and also personal tax matters. But this episode, we're totally focused in on why 2024 is, as you call it, Julia, a golden year for tax planning. And so why is that? Why is it such a golden year?
Well, next year we've got the new lower tax brackets. So for every dollar deduction you claim this year, you're going to get 2 to 7 cents more back off the tax office for that dollar than what you will if you claim it next year. So this year you want all the deductions you can get, and next year you want all the income you can get if you can shift it around within reason, of course.
Of course. Now, let's bring up those tax rates and look at the 2023-2024 financial year versus the new financial year that's coming, that was announced and passed through Parliament. So the changes to the so-called stage 3 tax cuts that we now see. And so you can see the differentiation there between the actual ranges, so when the certain levels kick in, and also to your point you're just making around some of that positioning that you get around 2.5 cents extra. And obviously if you add the Medicare levy in on that as well, you can see some of those changes there. So what we're talking about here is, if we've got this change coming, then obviously the higher the deductions you have in this financial year, the better you are off, aren't you, Julia?
Yes, the Medicare levy is not going to change, but the people over 45,000 are going to go from 32.5 cents in the dollar down to 30 cents in the dollar. But also that goes on until you get to 135,000 next year, whereas this year you get into the next tax bracket at 120. So there's a particular gain for those between 120 and 135. But you can't lose. If you can move it into next year, within reason, you really got to talk to your accountant and look at your particular circumstances. But no other year is going to be like it. In fact, on the other hand, this is the highest tax year we've had for years too. It's no low income, only the bare minimum low income tax offset, not the middle income tax offset. They've taken all that away.
So when we know that there's a differentiation between obviously the tax rates from this financial year and they're going to go lower next financial year, the more of the claims that we can get in the current financial year, the better. And that leads us beautifully into residential property investment. And so what are the legitimate ways in which we can look to make higher claims this year? And one of those is rental property paying interest in advance. So ultimately it means where you pay 12 months in advance, and that allows you to potentially reduce your income during that period. What are some of the benefits or gains we might be able to see as a percentage terms in doing such a thing, Julia?
Well, if you can move your income down below 120,000 this year, and push it up into, but as a result, because you're not going to be able to claim the interest next year, you possibly get up to as high as 135. In that ideal tax bracket, there's a 7% increased refund as a result of those deductions. So if you pay an extra $100 in interest, you get an extra $7 back in your refund off the tax office. Now, I know it's not worth buying an extra ream of paper or something like that, but it is worth it when you're looking at interest payments and super contributions. But you've got to make sure you don't move into the brackets. You've got to look at the whole picture. You've got to do the planning. You've got to talk to your accountant. You've got to say, well, but hang on a minute, I'm going to move myself too far down. And I'm not, it's got to be, you've got to look at those brackets.
Yeah, you've got to find that sweet spot. That's exactly right. And a lot of people who have looked at paying interest in advance in the past, they do get themselves all caught up that eventually it catches up to them. So, good times when you think about this is if you're taking a year off for maternity leave and your income's going to drop significantly. So you could forward book that in terms of that type of thing, because eventually it does catch up. But it's because we're making this tax adjustment down that this year becomes that little bit more interesting in terms of doing those numbers. So that's why it's best to talk to your tax advisor and get some tax advice and do some planning prior to 30 June, because that's when it's going to matter. Now, of course, dealing with a lender who does this type of work, not all lenders will, so that's also a consideration. And they normally need a bit of time to be able to prepare the paperwork for this to also happen as well. So there are a couple of things in there that you need to line up, and so there's not a lot of time for that particular window. I want to move on now to talking about rates, insurances, and body corporates from this sort of point of view. So what do you see happening here in terms of, is there any ability to pay some in advance, or what are some of the technical things we need to look at for here, Julia?
Well, certainly when the year you pay it, you get to claim it as a deduction, even if it's for next year, but you can only pay 12 months in advance. You go over the 12 months in advance and you've got to pro rata it. So imagine if you've already paid your body corporate fees up to 31st of December, you can't pay another year's in advance. You just got to pay 6 months more in advance. And you should be able to find out what they are, because each AGM, they set out the body corporate fees to pay it. But these days with electronics, it's hard, it might go astray.
Yeah, well, it's still an opportunity. Yeah, there's money to be had there. We're talking 2.5 cents up to, in some cases, 5, 6, 7 cents per every dollar. So, we're not talking, it's not going to necessarily send you to the Bahamas for the rest of your life, but this is about, making every dollar work for you. And so they are some of the options. Rates, body corporates, insurances could also be something that you consider, in terms of paying in advance as well. But again, only that 12-month period. Otherwise, it's prorated in terms of what that story looks like.
And then on top of that, like every other year when we think about prepayments, you get the money now off the tax man, you get to keep it for a year too. So it's just that added, that's what makes it the golden year.
Yeah, and I really like that point. That money could be sitting in your offset account, making you or saving you even more interest, because again, it's a 12-month period before you potentially have to pay that. So we do like that as a strategy, again, legitimate strategy as part of your tax planning endeavours. Now, what about land tax, Julia? What's the go with land tax? Is there a way in which that could be forward paid, or any opportunity there?
No, the land tax actually applies to the year that you that the bill is for. So it doesn't matter when you pay it, because quite often people get it come back several years later, and you have to go back and amend the return to claim it for the year that it was in. So no gains there, I'm afraid, Ben.
Okay, so but I think that's a really important point. So people are getting excited about one of the other larger bills that we have, which in some cases is land tax. There's no real benefit in doing that. It just aligns to the financial year, and there are adjustments made on that over time. So nothing to see there. When it comes to commercial property, people might be holding commercial property in their personal name, or in a passive investment trust or something like that. What do you talk about there in terms of some tax planning for commercial property, Julia?
Oh, well, it's more the other way around. I'd be really worried about your tenant paying a year's rent in advance themselves, because they're obviously going to get a tax deduction for the rent because it's a commercial property. I don't know, run and hide, don't but if they do, and that's within the period of their lease, you're going to have very little argument to say, it's unearned income, I don't have to declare it. It would be very hard. You'd have to say, well, no, they've just paid in advance, I've received it, and they have to pay it to me, and there's no denying it. There's this old principle, Arthur Murray Dance School or something, where he argued successfully that no, if they didn't turn up for the classes, I'd have to refund the money, so it's unearned yet. But I don't see that's going to apply with lease payments, rent under a lease.
Yeah. If you're owning a commercial property, have a look at the agreement that you have in place, where there is potentially the ability for the actual tenant to pay in advance, and that could be something that, yes, you're going to have to adjust for. And I think that's a nice little warning there from Julia. All right, in terms of property repairs, Julie, this comes up every year. So we're going to talk about basically costs in running and managing a small little property business that you're operating there. So expenses is incurred that counts. So this is something that you mentioned in one of your notes to me. Why is it important in terms of the period that it's incurred that accounts? And why is it important to potentially get a quote before 30 June?
Okay, because we're really back to looking for every deduction we can now. So in a little while we'll discuss when it really is a repair, but let's just assume we've got a repair or we've decided we're going to repair the place, but everyone's doing it. You can't get the trade in. As long as you get the quote and accept the quote, and so you've told them to go ahead, you've incurred that expense. You mightn't have paid it, but you've incurred it because you're going to have to pay it one day. And on that basis, you can claim a tax deduction now for it before the repair takes place.
Well, I think that's a little bit of gold there. So a nice little clue in terms of how you can prepare over the course of these coming 7 or so weeks before we hit 30 June. Now, there's a lot of misconception and something that the ATO released, last week in a press release, talked about 9 out of 10 investment property claims are incorrect. And I think a lot of it has to do potentially with how we treat money that we spend on the property. I think a lot of investors just think that I'm running a small business, so anything that I spend on that property has some form of tax deductibility for me, but it's not always the case. There is definitely a distinction between improvements and repairs. And so can you just share with us why that distinction is so important in terms of whether it's claimable or not claimable, Julia?
Yes, well, you shocked me when you said 9 out of 10 because we certainly don't experience that, Ben. It's not nothing like that.
No,
so
it did surprise me too.
Out there. But so the only thing I can think of where it's a bit of grey area and inexperience might make people vulnerable is sorting out the repairs from the improvements from the replacements in its entirety. And as you know, we have a particular worksheet that eliminates that. But if in some cases they may bring into their accountant a whole bundle of receipts and say, yeah, I did the repairs, here you are, and they might just be put in. Or some people prepare a spreadsheet for their account and just list it as repairs. They say that's it, trust me. So I can't imagine that anything other than that somewhere in there the ATO is finding one little receipt or one receipt's gone missing. But anyway, to explain the difference. So a repair, most people, and this is the classic way, people say, oh, but it needed repairing to bring it back to what it was when it was brand new. But that's not a repair. It's only when you bring it up back to the condition it was in when you bought it. So if it needed painting when you bought it, that's an improvement if you paint. So you can't claim that as a tax deduction. Just pop that in your depreciation schedule and write it off over 40 years. But anyway, so did it improve the property beyond what it was condition it was in when you bought it? Then no, you don't get a tax deduction for the thing. Now, if it was your home before you did when you bought it, and then later it needed painting, but you went and rented it out for a couple of years, and finally you painted it, well, just because it became necessary to do the painting in the year you lived there, it doesn't matter. You owned it at before it became necessary to paint it. So as long as it's rented the whole year you paint it, you get the deduction for that painting. Okay, another thing is to use materials that are better than what was originally there, such as replacing a tin roof with tiles and stuff like that. But you are allowed to use, you wouldn't go trying to find old copper pipes instead of using PVC or something like that. You are allowed to use modern materials. You can't improve it beyond too much, beyond that, just what the modern equivalent is. So the next one, is another example of a tree, removing a tree. That's a good example of a repair, isn't it? So it's an improvement if the leaves, why are you removing it? If you're removing it because the leaves are clogging up the gutters, then No, it's an improvement. If the leaves have always clogged up the gutters, you're improving it by removing the tree. If during the time of ownership the roots got into the pipes, then removing it is a repair. But if the roots were already in the pipes before you bought it, it's an improvement to remove the tree, and so it goes on. Okay, but there's some weird stories. There's and these are ATO rulings where they've said to remove the carpets and polish the existing floorboards was considered a deductible repair, yet underpinning due to subsidence was considered an improvement. Now, so go figure.
Well, that probably comes back to was the house subsiding before you bought it, and hence that continuation. The other one that's also really important that you also like to share is the one about some part of the original component or structure being left behind. Can you talk to that story?
Right, well, this is the issue about replacement in its entirety. So we've got to make sure it's a repair, not an improvement, and it's not a replacement in its entirety. So to replace something in its entirety, there's nothing left of the original. You've got to have the original still there to have repaired it. So the walls of the house are part of the entirety of the building. So if you replace the whole roof, that's all right. That's a repair, assuming everything else. It's not a replacement in its entirety because there's no way that roof could exist without the walls to hold it up. Okay, so the house is the entirety. But the kitchen is an entirety in itself. You replace the whole kitchen, then it's not a repair. But if you took the cupboard doors off the kitchen and put modern ones on, that's a repair. So, you like that one, don't you?
No, I do like those because I've seen both done, and I've got a situation with one particular property at the moment where we've had a lot of hidden water get into the back, and it's rotted the sort of back parts of the frame and the cabinetry in the kitchen. So we're going to have to obviously do an insurance claim, and potentially to make it safe and for quiet enjoyment, we're probably going to have to rip the kitchen out and put a whole new kitchen in, as an example, because of that water damage that's sort of been hidden from eyesight. But that's an example where it's obviously I'm changing the whole kitchen unit. Is that a repair or a replacement because I've had water damage in that property?
Well, you're going to get insurance claim, you told me.
Yes, we're hoping to get an insurance claim.
So you're going to undertake the repair.
That's right. So we're not paying for it, so it's not a cost. Yeah.
Well, that's the trouble. If you're replacing the whole kitchen, the insurance company's going to be paying for it. Get the insurance company to pay for the replacement. Don't give you the cash, because then you've got the problem. Right? But if you're... Yes.
Yep.
Okay, so you don't have to split hairs over this. Just say to the insurance company, go right ahead, get your tradies in, do what you're going to do. Right, so, but also if you're not going to do all of the repairs, you get the cash from the insurance company. And if they are repairs, like you're saying about the boards at the back and that you've got to replace, you say, I'll claim a deduction of $10,000 for doing that. I've got $40,000 from the insurance company. I have to include as income only $10,000 to offset that because it's recouped. The other $30,000 that I haven't spent just comes off my cost base. So basically, you've got the money sitting in your favourite place, the offset account instead.
Very nice. And in terms of the interest excess, the insurance excess, is that deductible if I have to pay an excess?
Yes, but I'm thinking that yes, if they're going to replace it, you'd have to pay it. But when it comes to an insurance payout, they normally reduce what they give you by that. But yes, going back to the idea of get them to replace the kitchen, yes, you would deduct the excess.
Okay, so a couple of ideas there that we've seen come out. So obviously that whole area of what is a repair, what is an improvement, what is a replacement, and what would form part of a capital cost. So another classic examples, which we're going to move now to what we call new plant and equipment. So again, that's why we should always talk to our accountant before we do anything, because they're going to give you these pieces of gold, these little bits of advice in terms of how you set up for success. But let's talk about new plant and equipment. So when I replace a stove or some carpet or air conditioning units, what's usually the result there in terms of whether I can make an immediate claim versus when I can actually write that off over a period of time through depreciation?
Okay, so as you know, the stove is going to be replacement in its entirety, so we're out of the grounds of
Yep.
repair. So then
Yep.
you've got a depreciable item, and you could take out of your depreciation schedule the old stove and write that off. And then you've got this new stove that you bring in and you depreciate it over its life, maybe 10 years or whatever the effective life is for a stove. But
Yep.
if that stove somehow, so there's two owners of the property, cost you less than $600, I'd rather a dishwasher in that example. Stoves is a bit hard, but maybe.
Well, let's use the dishwasher as an example. Let's use the dishwasher. Yep.
Yeah, so the dishwasher is under $600. So two owners of the property, so it's under $300 each. You get an immediate write-off for that. If it's under $1,000, you get to write off only 18.75% the first year. And so it's not really worth, not getting a lot of the money back. But worse still, if it's over $1,000, then, and you bought it in June, you're going to get very, because it's just pro rata over its life, isn't it? So, yeah, I wouldn't be bothering. The last thing I'd be doing is bothering replacing a stove over $1,000 at this stage. Not much to gain.
So there's a couple of nice little tips around plant and equipment in terms of, and I'm going to come back for the importance of ownership. This is an important tip around first owner versus subsequent owner. So there is some rules here that the ATO also have in play that, sort of could be forcing a non-claim on something you've spent. So do you want to talk to that and then also talk to the exemption that might also be in play there?
Yeah, well, this is another reason why you want the insurance company to put that kitchen back in. You don't want to do it yourself. So if it's second-hand plant and equipment, you can't depreciate it. So it just goes on your cost base for capital gains tax purposes. Now, to define second-hand, so it's got to be first used from brand new to produce income. So you've got, if you're living there, put the stove in, never even bother turning it on before you move out. Doesn't matter, it's second-hand, it's been used by you, you can't depreciate it. Similar, if you get just a cabinet maker to come in and do your kitchen, and he says, well, I'll go to Bunnings and pick up a stove for you and I'll just put it in the bill, then you're not going to get a deduction for that stove because he's the first owner of it, not you. On the other hand, if you did a significant renovation that affected every room of the house, or when you do a new build, it's the plant and equipment is considered the trading stock. So they're the Bunnings that it's bought off when a builder does that. So then it's brand new to you. And there's I think you like this one, the little trick that a property developer develops a property, gets a certificate of completion, and rents the property out while they're trying to sell it, and they sell it in less than 6 months. Well, then, believe it or not, contrary to everything else I've just told you, that plant and equipment's still brand new because the builder still owned it, and they didn't hold it. Has been less than 6 months since the building was completed. So go figure. It's just designed to catch the little person, isn't it?
That's what I love about you, Julia.
And you wonder why so many claims are wrong.
Look, I love that about the nuance that you know about those little sort of situations and the rulings. We're talking about rulings that set up how we're guided in terms of what's deductible and what's not deductible. So, that's why, you're our chief tax advisor in that particular sense, because you understand all of those little nuances. I think so let's go back to that first ownership thing. That's really important. So if you say to the tradie, go off and buy it, you need to go and buy that, those components if you're doing a small reno or a small fix-up. Don't get the tradie to buy it on your behalf. Even though they can potentially get a better deal for you, get them to get an invoice in your name and you pay for it direct. So you become the first owner of that good, not the second or subsequent owner of that good. Also, if it's a second-hand product or something like that, same principles apply. You're not the first owner of that good. So ultimately, you won't be able to write that potential plant and equipment off. So there are some really great tips in terms of what you're talking about there. The other one that I think is also quite interesting is this whole idea of repair turning into improvements. And I know you used one of the good examples that we've always talked about is you've got a tin roof but you turn it into a tile roof. I mean, technically, that would exempt your ability to obviously make that as a repair claim as opposed to making that an improvements and something that's going to be written off over time?
Yeah, there's no, not even a deduction for notionally what the tin roof would have cost you. But if you went from, say, corrugated iron to metal deck, because that's what they do nowadays, that would be all right because you're just using the modern equivalent.
Yeah. So, but really important to understand that if you're, replacing a laminate top and putting a stone bench top on because the laminate had been damaged or burnt or whatever, is that another good example of where, that's considered an improvement because you're using like for like materials?
Yeah, but there's a horrible case that, again, I can't reconcile, similar to polishing floorboards, that there was a damaged piece of a bench top, and they replaced the whole bench top because they couldn't match the bench top, and that was considered an improvement. But hang on, you didn't say laminated before, did you? You said a...
No, I did say, let's say it's laminated to stone. Let's use that example. Yep.
Yeah, no, that's an improvement too. Sorry, I thought you were saying stone to granite. Yeah.
Yeah, so laminate to laminate is the same sort of example. If you can't match it, but you've used a different type of laminate or whatever, would that be considered an improvement?
Yeah, because you replaced the whole bench, unfortunately. And that's a little bit of a one I'm uncomfortable with, but they said the bench was the entirety. I don't think so. I think it needs the cupboards to hold it up, just like the roof needs the walls to hold it up. But that case did go through.
Isn't that interesting? And then the last one, which is normally a consistent repair every 7 to 10 years, is fencing. So we've talked about this one before, but for our new community members, and new clients, this one's a good one because if you've got a part of a fence that's damaged and in desperate need of repair, but the other sort of end fence or other side fence is in good shape, but you decide to replace the whole lot because they're 15 years old, is that considered an improvement or a repair?
It's a replacement in its entirety, so you're out the window, and it's 40 years you have to depreciate that cost. Whereas the tax office ruling even says that if you replace the fence a little bit at a time over the years and eventually the whole fence is replaced, doesn't matter, you're allowed a deduction for each one of those. So don't replace the whole fence.
So there's another great little tip from Julia. Don't replace the whole fence at once. Just do the areas that need repair appropriately as they need repair. Otherwise, waiting 40 years to write off that is not going to necessarily be great for cash flow. We've talked about the tree removal one, so it's a really good one. Depreciation schedules, Julia. Depreciation obviously has a period of time. I think it's September. So if you can explain the month and the year, that's important. Past that time, why are depreciation schedules so important?
Right, so the year you're trying to remember is the 16th of September 1987. If your home has been built or renovated after that date, then there may be some building depreciation in there for you. And if you don't know the original building or renovation costs, then you're going to have to get a quantity surveyor's report to do this. Now, this is another one of those timing differences. Your depreciation report is, the cost of it is totally deductible in the year you get it, because it's a cost of managing your tax affairs. It's not something that has to be amortised. So if you pay that now to get that before the 30th of June, because you're going to need it come July or August anyway, if you pay that now, at least you get the deduction sooner and you get a portion of that money back.
And my understanding is you also get potentially the 2 years prior, or is it 3 years prior? I'm trying to remember that you're able to claim prior years.
Well, I'm assuming when I've said that you've just brought the rental property this year. But yes, if you should have been claiming depreciation and you haven't, you can amend previous tax returns once you get it to claim the depreciation. Now, generally the ATO will say, you can only get back 2 years, and that's 2 years from the date of the assessment notice is issued. But if you own a jointly owned rental property, your amendment period is 4 years.
So you can go back forward. There's another bit of gold, 2 years or 4 years. Now, of course, we work very closely with our good friends at BMT Tax Depreciation Schedules. We get nothing out of it other than a cheaper price and a discount for you. So if you check in the show notes as well, we've got a form there. They've also got a depreciation calculator on their website that you can potentially do some idea about what that schedule might look like. And I will say this also, they have a guarantee that if the cost of the depreciation schedule isn't claimable or added back in that first year that you pay for that schedule, then they'll do it for free. So they're only interested in doing schedules that actually add value to your cash flow management, not necessarily doing it the other way. So I think that's also an important message. That's why depreciation schedules are really important. If you haven't got one, they're really important for that cash flow story and making sure that holding costs, because we know they're all going up, and this is a way to basically get some of that added back so you get a little bit more of that tax return in the earlier, in the current management periods that you're looking after that property. All right, so I think we've done a fair bit and enough on rental properties. Let's now turn our attentions over to the individuals. And this is a big story here, right? So we've got diaries and logbooks. These are quite important things, and we talk about keeping them in order. So what evidence do I need to apportion personal versus any type of claimable costs that I've got in performing my duties at work? What are those diary books and logbooks that I need to get organised, Julia?
Right. Well, we'll concentrate on the car separately, and we'll just go for the basics. To claim anything that's got some private business use, you need to apportion the cost, assuming your employer hasn't paid for it, but you have.
Yes.
So it might be a portion of your mobile phone, a portion of your internet at home. Oh, that's a nightmare trying to do that. A portion of the depreciation on your laptop. And to do that, you need a 1 month diary showing the hours used for work and the hours used for private. With your phone, it's a bit easier if you get onto it now, because you should be able to go back in your recent calls and see the last month, screenshot them, print them up, and write W or P beside each call so you can work out that ratio, and then you apply that to your phone bill.
Fantastic. So
logbooks.
Well, let's hold off on cars first. What about, obviously a lot of people are working from home, so the home office expenses. So we've seen some changes. We spoke about this at last year's tax planning update that we did, but tell us a little bit about what your views are in terms of the way in which the HO is treating working from home and those home office expenses and electricity and heating and all of those things that go with it.
Yeah, they realised that was a big bleed when they were generous with that. So now they've narrowed it down that you only get 67 cents an hour, not the 80 cents it was. And that 67 cents covers your phone, your internet, your electricity, your stationery, and that includes printer cartridges and the like. So if you're using your phone a lot for work, there's a good chance that 67 cents an hour isn't enough to cover what you could have claimed with your phone. And so you might instead consider actually using the actual cost method. Instead of the 67 cents, you keep all your stationery receipts and you claim that. You do the phone as we discussed. The laptop, you do the diary for 1 month. And if you want to, you could even claim the electricity on the basis of a 1 month diary of how many hours you're in the office. And what you do is you turn everything else off in the house, turn the stuff in the office on, and go out to the meter and you look at how much is used and you look at your phone bill and you work it out. It'll probably come up to about 20 cents an hour or something like that. And then you've got your diary for 1 month and you say that's a representative sample and you multiply it out. It's certainly, because now, to get that 67 cents an hour, by the way, you've got to record every hour. It's not a 1 month diary with the Home Office anymore. It's the whole year, how often you're at home. Whereas do the electricity thing with the meter, let's face it, it's less work than keeping a diary all year, and you work it out yourself on a 1 month diary. It's the same with everything else.
There's a little bit of a tip there, but bookkeeping and record logs and receipts and all that, they're obviously, they're a bit of hard work, but if you want to get a claim, you've got to basically be able to prove it to the tax office if they do come knocking on the door. Let's now turn our attentions to car expenses quickly. We've got the logbook method and also the 5,000 kilometre method. Can you just talk us quickly through car expense claims for work?
Okay, well, we'll start with the kilometre method because that sort of then shows you when you might consider the logbook. So you can only claim 5,000 kilometres for a car under the kilometre method up to that much. But you only need to keep a 1 month diary of a detailed reasonable estimate, and then you can add a list of, occasionally you might do a big trip and you just write that in as not a representative sample, but you just add it on and you multiply it out. 1 month diary per car, 5,000 Ks. So if you rotate cars with your spouse, you really get to claim 10,000 Ks. And it's 85 cents a kilometre this year, so that's rather attractive in many cases. And especially if the car's older and there's no depreciation left, no interest on a loan or anything like that. But for a newer car, the logbook method allows you to claim a percentage of the interest, the registration, the insurance, and depreciation. So you may prefer to keep a logbook to show a bigger percentage is used and get a bigger deduction that way. The logbook has to be kept for 3 months every 5 years. So if you're thinking about doing it this year, you've got to start now and at least have it started before the 30th of June. And then you need to keep all the receipts for everything. Speedo reading every 30th of June should be taken anyway, definitely for logbook, but for anyone else, you never know when we can use it. Just do it for us. So that's another out there, people.
Yep, great tip.
Yeah, 30th of June, just take it, please. You can keep the receipts for your all your expenses, but you don't necessarily have to keep the receipts for all the fuel. As long as it's not a 1-tonner or a bus or a truck or something like that, you can estimate the amount of cents per kilometre it costs you in fuel. And you do that by taking the speedo reading, filling the car up. Next time you fill up, you take the speedo reading and keep the receipt, and you use that receipt to work out how many cents a kilometre you're travelling, and you've got this speedo reading I was just nagging about, and you work out how many kilometres you did for the year, and that's the way you record your fuel.
Beautiful. So there's the car expenses again. We're recommending you speak to your accountant, get everything organised, but get that book. I mean, you don't have a long time to actually, do that logbook method in terms of coming up to 30 June as well. So that's really important in terms of getting started on that. Now, I want to turn our attentions to any potential, if you're a PAYG and you're potentially looking at a bonus or some type of payment, a commission payment and so forth. This one's comes back to the story we were telling you before about the changes to the tax rates that we're seeing between 2024 and 2025. So you've got a little tip here about potentially delaying that payment into July, Julia.
Yeah, well, say you got a $10,000 bonus and you're on $120,000 a year. So you're going to lose $700 if you get it this year compared to if you take it next year. Simple. Delay it.
Pretty simple. So there's a $700 tip right there in terms of delay that if you can to receive that payment in the new financial year. All right, that one's great. Let's move now on to superannuation, and we're not going to do an exhaustive deep dive into superannuation. We've done some super stuff before, so check out the old previous episodes. But what I want to talk about is what's different in this tax year versus other tax years. So the first one and the most important one is this making a concessional tax deductible contribution before 30 June. Can you talk us through that and why it's important?
Right. Every year it's worth considering because you're moving the money from your marginal tax rate down to the 15% tax rate, assuming your income's not over $250,000. And of course it's locking it away in super, so you've got to be prepared to part with the money. But there's also this unused cap. So if in previous years you haven't used your full super, which was 25,000 and then went up to 27,500, anything you haven't used is just saved up for up to 5 years, and you can make that extra amount too. So if that's been accumulating there, you might want to think about, especially if you're in that $120,000 to that $135,000 bracket, you might want to consider using some of that as well to contribute in there and just claim it as a tax deduction in your tax return. You get a nice refund back when it comes. But you've got to tell the super fund you're going to claim it as a tax deduction. And the key word is voluntary member contribution to get them to understand what you're trying to do.
And so just so I've got that right, Julie, what it's also meaning is that means that the total earnings that I get bring me down into that tax bracket. That's what you're talking about as well. Like it reduces the overall gross earnings of income
because
you've made that contribution into super?
Yes. Okay. So let me say you earned $130,000 for the year, and you take $10,000 of your after-tax dollars and put it into super, and you tell them that you're going to claim it as a tax deduction. So that $10,000 brings your income down to $120,000. So you, instead of paying 39 cents in the dollar by the time we add the Medicare levy on it, that you're going to, that $10,000 is going to give you a $3,900 refund, right? Because you've claimed a deduction for it. But instead, you put the whole $10,000 into super, but there's only $1,500 that's going to be paying tax in there. So you got $8,500 working for you, whereas you would have only had $6,100 in take-home pay. That's what you were trying to get me to say, wasn't it? That take-home $6,000.
Yeah. So again, it's all about, so those tax ratios, those steps up in the 32 cents in the dollar and then 39 cents in the dollar, they matter, and so that's why that tax planning becomes quite important. And now, but I think it's really important to understand here that you are saying goodbye to that money to potentially 65 or maybe 67. When you say goodbye, it's going to accumulate in your super fund, and hopefully you get to see it in retirement. But that's the message that we've got here. So some of that little nuance of tax planning is really important. Now, there's lots of other sort of tax and superannuation planning work that you can do, but we were just going to highlight that one because it's relevant for this tax. The tax rate changes. I'm not using the right word, Julia. What do we call each of the different steps? The 32 cents.
The
brackets. Thank you. There's the word I was looking for. So the tax brackets. So when you're inside those different, that's where the planning becomes important. The other thing that we want to just quickly highlight on super, outside everything else is normal as we've talked about before. Check out the previous episode. Is any superannuation contribution incentive for low income earners? Is there anything that a low income earner could do, whether that's mum working part time with a young family and just earning a little bit on this? What is there any type of incentive or contribution that they should be looking at?
Right. Now, we are going to give a fact sheet at the end of this, aren't we? Because I've given you one. So
yes, we're definitely going to have more information on this.
Yeah, so the fact sheet has got a little table in it, so you don't have to remember these numbers as I say it, and that also is a great segue for me to have a quick sticky beak at what the threshold is here. 43, there we go. If this person has got only earned $43,445 in income, right, that's adjusted income, it's not your taxable income. If they're under that, if they put $1,000 into super, the tax office will put another $500 in for them. So that's
money for nothing.
Yeah. And neither of those ones get tax going into the super fund, okay? But they don't get a tax deduction for $1,000. But in their tax bracket, they don't need one. It doesn't matter.
No, I was about to say that. Yeah, they're already getting a pretty good deal at the income they're living. So just please think about that. That's additional money. If you've got a high income earner in the household and a low income earner in the household, look at that as an option. If someone's working part-time because they're raising a young family, those types of things are also important.
Yes, and there is another one where you can make a spouse contribution, where you put $3,000 into super for your spouse. If their income, adjusted income, is under the $37,000 mark, then you'll get $540 back off the government. And that $3,000 won't be taxed going into the super fund. But it's always still better to make a contribution for yourself than do that tax-wise, okay?
Contribution to yourself first, but then ultimately if there's still a little bit of extra left over, there's a potential opportunity to also do a spousal contribution. So there's just money on the table here, people. This is our job, is to show you where the money is, as opposed to giving it to the government. We've said before, they don't do very well with it in terms of what they spend it on. So we might as well get as much of it as we legally are entitled to get. Now let's change pace a little bit there, Julia. Sorry.
I did want to say that to make it fair for the low-income spouse, I've said no, put the money in the high-income spouse if there's any room left to put money in for them. To make it fair, then what you do is tell the super fund to move it across to the spouses. super account. So you put $100 in, they pay the $15 tax on it, and you can move $85 across into your spouse's super account. It goes against all your caps, but it then can be invested for your spouse. So while I'm not saying, take it all to the high income earner because they've already got enough in super, I'm suggesting you do it this method and then move it, to be fair. Okay.
Yeah, no, yes. And, we speak a lot about the inequities between a mother or a female raising children and not being in the workforce and having a shortfall in retirement compared to a male who might be gainfully employed during that time. So I think that's a lovely thing to say, in terms of reminding how you can potentially top up your partner's super. That's part of that particular story. So another excellent tax planning opportunity there for those in the superannuation space. Right, let's change pace a little bit now. I want to talk about all of those people carrying HECS or higher education debts, help debts, sometimes as they're referred to now. And so we did see, not this weekend, but last weekend, the Labor government announced before the budget was released last week that they were going to make some changes, retrospective changes, and I've got some numbers here. So effectively, in the 2023 tax year, where you and I were screaming out to people who had HECS debts, is to pay as much as you can off it before the 1st of June, not the 1st of July, the 1st of June, because it was going to be increased by 7.1% because that was the inflation figure at that time, the annual inflation figure. Now, what we've heard from the Labor government, the federal Labor government, is they are retrospectively going to go back, which is effectively a 4.7% saving, and they're going to use the wage price index in terms of wage growth index, I should say, in terms of how they're going to calculate that figure. So retrospectively, if you have paid that money, they're going to adjust that in any outstanding debt. So what's good about that? It's obviously a significant investment, $3 billion. So congratulations to those people who are going to get cheaper interest on their HECS debts, but it also affects around 3 million students. So that is a good news story for those. But what doesn't change, to your point here, Julia, so whether it's the wage growth index or adjusting for inflation, is that come the 1st of June, 2024, i.e. coming up soon, right, in a couple of weeks' time, you need to do as much as you can to pay down your HECS debt as best you can with the amount of money that you got freed up that won't put you into any type of financial stress. Do you want to talk to that story, Julia?
Yeah, and yes, do that if you think you can. But if you don't pay all your HECS off, still when your tax return goes in, they're going to take some out in HECS, depending on what your scale is as to how high your income is. But most importantly, this strategy works very well in your last year. So if you think the amount the government's going to take out of your tax refund to pay your HECS this year is about what you owe, then beg, steal and borrow the amount to pay it now before the 1st of June. And then when you do your tax return, all that HECS that your employer's been taking out will be refunded to you and you can pay the people back. But the trouble with the balance at the 1st of June is not the balance less what you've been paying during the year. It's the amount that you had basically when you did your tax return last year, plus any other courses you've done since then, because the money that your employer takes out is just tax withheld. And until you lodge your tax return, that's not allocated to your HECS debt. If you've got extra money, you can pay it off and save yourself the uplift factor. The uplift factor is probably going to be about 4.2%. So if you've got a credit card debt, it's better on that. Of course, when you do your tax return, if you still have a HECS debt and you've only just paid part of it off, then when you do your tax return, they're still going to take the full amount of HECS off you. But if this is the last year anyway and you pay it down now, then you're just going to get that money back when you do your refund and you can then pay it off your credit card. So that's worth doing everything. But to pay it off, to only pay part of it off, you've got to consider that it's only costing you 4.2% or similar a year. Last year, the wage price index was only 3.2%. then you probably got other things you'd be better paying the money on. But in the last year, definitely worth doing.
Okay, thank you for clarifying that. All right, let's move along finally to talking about people who may not have actually got around to actually completing their 2023 tax returns, Julie. So even though we're planning for 2024, what if they haven't sent in their compliance tax return for 2023? What's at risk, or what are some of the challenges that they may face from the ATO for a late lodgement?
You just made my blood run cold. Because what really worries me is the person that's getting a bit of Centrelink money, and they may have to pay it back, and they may not be able to afford or even think it's important to lodge their tax return. So if they haven't lodged their tax return by the 30th of June 24 for the 23 year, Centrelink will be saying, righto, give us the money back, and you won't get it back when you finally do lodge. Righto. And another thing to consider is if you're going to claim super contributions as a tax deduction in your 2023 return, you have to, before the 30th of June 2024, notify the super fund you're going to claim them as a tax deduction, because they have to adjust their...
So a couple of bits of warning there. And so, that is very sage advice in terms of please try and get your tax returns in as they are meant to be done each year by the required time that you need to do it. If you've got a tax agent, you do get a bit of extra time to also complete your returns, but please get them in, because there might be some money that you may expect to be getting back, but the ATO withholds from you because you're late with your tax returns. So let's summarise up. It's been a great hour that we've had together. We've obviously, to your point, we will have all of this in a nice fact sheet that people will be able to click on the link below and be able to read some further information and some very, very simple examples we've got in there. Just remember, it's very general advice. We highly encourage you to make sure that you speak to your tax accountant when you're doing your tax planning. Don't assume anything is the view that we take when it comes to tax legislation, and always make sure that you're maximising those deductions. So it brings to a close another great episode, Julia. Thank you very much for your time and sharing your expert knowledge. And it's always a great reminder to watch those other episodes so you can keep building up that tax knowledge as well. And of course, as I just mentioned, getting that specialist tax advice, I think, is critical. I know that the value versus the cost that I pay is always returned to me in spades. I'm always learning new things, such as the HECS story there in terms of what actually happens, in terms of getting that right. I don't have any children with a HECS debt, and I'm certainly HECS debt free at my age. So that gives you some idea. But thanks again, Julia, for your amazing insights.
Thank you, Ben.
And I always say this is, remember, knowledge is empowering, but only if you act on it. And also remember that tax planning has a deadline on it, 30 June. So make sure you're booking in with your tax agent for planning. And then obviously after 30 June, it's tax return time. So hopefully you've got a bit of money coming back to you. So make sure you book in with our tax team and get that locked in so we can get that money back into your hands, back into your offset, and saving you some money. So thanks again for everyone. And we'll have a catch up with Julia later in the year. But until then, bye for now.